How to use based assets. Welcome to another video. My name is Kügi, and as always, I try to provide you with data and insights so that you can make smart decisions for yourself. Today, I'm looking again at this new protocol based assets. And today we'll look into the part how to use it and what it means for the normal user on the blockchain. I already did another video, which is a technical deep dive into the protocol. So if you look more into the details and want to know more about that, check out the other video. But today it's more on the end user side. As always, disclaimer, this is not financial advice. This is just for your own research and giving you the insights that I gained from the stuff, and my opinions on it shouldn't influence anything that you decide. Make your own decisions, be your own expert, and do your own research and make smart decisions. Also, I don't get paid for that. Based Assets just reached out on Twitter and asked for people who would like to get an early insight in their smart contracts before they launch, and do maybe some content about it. And since I follow them because what they build sounds really interesting to me, on the one hand, I would like to use that. On the other hand, it's very similar to stuff that I've been studying for a few years now. So I'm always interested in learning more there and seeing how these things go. So I couldn't say no, and just contacted them and got access. And now all I'm presenting here, all I'm talking about is based on the one hand on their white paper, their testnet deployment, and my insights into their smart contracts now. So into the current code base. Doesn't mean that this will be exactly like that on the go live. So they are not on mainnet yet. So basically everything I'm telling you now is with a bit of an if and maybe, and if nothing changes. But yeah, that's important to know. And once they go live, I likely do another video and check if everything's as they said it is. So with that, let's look into the plan for today. First, I will again look into who are they, because even if you just want to use the stuff, I think it's important to know who they are or what that means for you. Then just a quick recap, that's why it's smaller, quick recap on what they actually build, about the stability and all the pros and cons. As I said, I did a more detailed video about those points before. So if you want to look deeper or get deeper insights there, check the other video. But it's not necessary to watch the other video to get what I'm talking about today. So I will not go into too much detail, because today is more about the last part. How can you use it and what does it mean for the average user? So let's jump in. Who are they? And the answer is short. They are anonymous. And I think some people think this is a bad thing. I think this is a good thing, because for me, true DeFi means it should not matter who built something. And if you don't know who built it, means you can focus on what they built and not who built it. And because in DeFi, we often talk about don't trust, verify, and all that stuff. So this is the way to do it. For me, this opens also a bit of a thought experiment sometimes. So if you want to have a person behind that or some image, consider the worst scammer you know to build that protocol. Then analyze the protocol with that builder in mind and see what you think about the protocol. And then consider that this protocol is built by Satoshi himself or the best person in DeFi you know. Whoever you think is the best DeFi builder and thinker and whatever, and consider that they built this protocol and do the analysis again. And in the end, whatever you think of the protocol, the value you see in it should be the same in both cases, because it should not matter. To have that, it's important that they provide all the source codes before the launch, that all contracts are verified, and that it's not upgradable. But we will talk about that in a minute. So that's important for me. Also, one important topic is that they have no project token. So right now there is no project token for this project. They also, the whole project is built in a way that it doesn't need a project token for incentives or whatnot. Doesn't mean that they will never do that, I think. It could be that later on we will see governance added to the thing about listing and everything, where a token might be used. I don't know. But the protocol works without the token, and there is no need to mess with a token in there. And so currently there is none, which also means they will not or cannot dump. They just want to provide value. So that's about who they are. A lot of words for a short answer. Anyway, next step. What did they build? In short, they built a decentralized real-world asset system, which produces based assets, and that also includes a decentralized stablecoin, which is the BUSD, so based USD. Why based? Because they are on base, so it's kind of a catchy name to say based assets on base. This, I'm not going into the detail about this dual forge system, blah blah. If you are not aware or not really know what I mean with a decentralized real-world asset system, you should pause now and watch the other video where I go into details about the differences between decentralized assets, centralized CeFi real-world assets, and CDeFi real-world assets, because there I go a bit deeper into what real-world assets are and how they can be done on the blockchain. So watch that before this one, but if you know, then let's just continue. To get a bit of an overview on what they built, let's look at their system. This is now from the other video. So if you want to go into detail, watch the other video. I will just quickly recap. The core of the system are forges where any user can put in collateral and mint, so create based assets and the based USD, so B assets and BUSD. And those B assets, there are stability mechanisms like the USD stability and the asset stability within the system that ensure that the prices of those assets are tracking the real Oracle price loosely. I will go a bit more into the way they track that, or how tightly they are to the Oracle in a bit, but overall that's the system, and it creates decentralized real-world assets. Main features: collateralized forges for the creation of BUSD and based assets. They call it forges. Most of the other protocols call such things vaults. So if you know vaults, that's likely a better name for you, but it doesn't matter. Then they have the additional stability, and they have quite some safety mechanisms to keep prices in range and also keep the system healthy. If you want to know more about that, watch the other video. Then let's look a bit into the asset stability, because I think that's important for end user to understand how based assets will stay close to the price. And I think that's pretty unique within the space, that it's done like that, because there is no continuous mechanisms or something like continuous fees or anything, but they define one time per week where you can trade or convert based assets, a B asset to BUSD or back, at the Oracle price plus fee. The fee is depending on the type of the asset. So low volatility assets have 2% fee, medium volatility assets like an SPY or something have 5% fee, and the high volatility assets like tech stocks or anything might have 15% fee. I hope they will go down with the fee once everything is smooth, but that's what the white paper says. And they have volume limits and everything. But this conversion at Oracle fee plus Oracle price plus fee, is what keeps the prices in check or gives the enough conviction or enough certainty to decentralized minters, who then provide the actual arbitrage and the actual backing for the system. Again, about all this decentralized stuff, watch the other video. But what you should take away from this is that BasedAssets might have a lot of volatility during the week, in between, but they will always come down within this range on Wednesday, because Wednesday afternoon is this fixed time for the conversion where this goes back into the range. So they might go around but come back into the range. I expect that they, during market hours, they will always stay within the range, because arbitrage traders, so decentralized minters, will already anticipate that they will come back into the range, so they can open during market hours when the real world asset, so the asset in the real world, is already open or is trading. They can always open delta neutral positions, profiting from a premium. So they will likely keep the whole price in range during market hours. Off market hours, so on weekends, we likely see more volatility. And in my opinion, that's a feature, not a bug, because if there are some important news, very bullish news on some stock or anything, or very bearish news on some asset, people already anticipate that Monday will be a good or bad opening, so a gap open. And with that, they can anticipate that in a decentralized world. So they can already buy the asset into a big premium on the DEX, on the blockchain, because decentralized assets have no opening hours. So they will put that into a premium, and then on Monday, once the market is open, you will see the differences or the prices converge again. But be aware that these decentralized assets might have a bit more volatility in the higher range compared to DeFi assets or the real asset. But it comes with benefits. For all of that, watch the other video. So with that, we know the stability, we know that stuff. Let's look a bit on an overview of the pros and cons of BasedAssets. As I said, pro is definitely the pure DeFi. You will have 24/7 trading and borrowing, so there is no off hours for this protocol. In my opinion, it has solid stability mechanisms and risk management about the whole thing. So it's a protocol that has a big potential to work. And like pure DeFi should be, there is no single point of failure or attack vector. So there is no central entity that can be shut down or blocked by governance or anything. It's a protocol on DeFi, no upgradability, no. All the tokens are ERC20 tokens, plain ERC20 tokens, with no freezing possibility or anything. So if you hold a B asset or the BUSD, no one can take it from your wallet, no one can do anything. Also means if someone steals tokens from you, no one will be able to assist you in freezing it. But that's the thing with DeFi. With real DeFi, with pure DeFi, if it's uncensorable, means uncensorable. There's no loophole in there. Also, it's not upgradable. As I said before, team can change the rules. If they deploy it like they say they will deploy it right now, it will be not upgradable, so the team can change the rules. Code is law, it's on the chain, and that's it. There is no need to trust them to do no bad updates or anything. Also, as I said before, no token, so no conflict of interest, no reason to weaken the safety constraints of the system just to pump the token or anything, because there is no connection to a token of the system. As I said before, right now, there is also no need for a token. Might be that there's a governance token later coming or anything, I don't know. But the system itself works like that, and that's a good thing. No dumping on community or anything. The cons, and now the thing is, pure DeFi, as I said before, uncensorable means is a plus and a minus, and here it's the same. Not upgradable is also a con, because if there's a bug in there, it stays in there forever. So as I understand the code, it's pretty stable. It's good. I'm not no auditor or anything. I'm no auditor, so take my opinion with a grain of salt. But it's so far I didn't find anything. Also, Copilot didn't find anything. But there could be a bug in there. And if they have a bug, people need to react quickly. If there's a possible exploit, people need to react quickly, take out the funds, and then they have to deploy a different version. So another version of the protocol. They can't just say we update the current version, because that's what we said at the Pro. It's there, and it's there forever. But as I said, also the con. Also the tokenomics, I think it's solid, but well, it didn't prove itself yet. There is no other protocol that worked on a long time frame like that, or ever tried exactly that. There is a protocol which tried similar thing, but did other major errors, which broke the whole protocol basically. I think they learned from the mistakes of this other protocol, but yeah, still we don't have proof that the tokenomics themselves work on a long time frame, because there is no protocol yet that has those tokenomics and yeah, still work as they should. So that's a bit of a question mark there. No token also means they have no way of incentivizing liquidity, handing out crazy APRs or anything. So the question is, how will they get initial liquidity? How will they attract a critical mass that uses that protocol? By pure value, that's a bit of a risk in DeFi, because most of the people don't care for value but care for high rewards, and value only attracts investors long term. So let's see. Also the Oracle dependency, they use Pive, which is for the Oracle prices, which is kind of industry standard right now. So I don't think that's a big problem, but I would love to see them getting more decentralized and diversified here. But I think that's something that they can do over time after the interest from the community is there. So that's a quick summary on the protocol. Now finally go to the how to use it, what does it mean for you part. And there first let's have a bit of this overview on what the protocol, how end users or normal users will actually interact with the protocol. And the short answer is they won't at all, in my opinion. Because if you are a user who likes real world assets, so if you want to trade a decentralized SPY or a decentralized MicroStrategy or anything, or a decentralized gold on the blockchain with all the benefits of true DeFi, you will likely don't even care for the based assets so you don't care for how this protocol works, as long as it provides you liquidity on the DEX and ensures a correct price on the DEX. Regarding correct price, we already talked about keeping it in range and everything, so it won't be, or likely won't be exact on the spot, but within the range. And that's what you care about as a user. And then you just use the DEX. In this case, it will be roam from on base, I guess. And you just use the liquidity there and buy the asset, hold the asset, or even trade it on the DEX. And that's all you care about and all you need to care about. As long as they do their job regarding those points, you just use that. There's only one additional thing that I think end users will also care about or maybe use, and that's liquidity providing. And for liquidity providing, you have on the one hand the option to buy the asset and then put it in as a liquidity. Then you have a long position on that asset. But maybe the most actively traded assets are the ones that you don't want to hold. So you just want to profit from commissions, right? And for that, BasedAssets has, in my opinion, a pretty smart approach. I mean, I'm a bit biased here because I built a similar thing like that for the other protocol that I talked about. So I like what they do here because I did similar thing before, but they do it on a completely different level. And that's they call it a community liquidity provider, where users can just deposit BUSD, so just a stablecoin, and then it uses the BasedAssets system to provide delta neutral position, and that sounds interesting. So let's look a bit deeper into how this works. And in short, we have here now the users on top and this community LP provider. And as I said before, the system provides those forges. And what the LP provider, it's a smart contract on the blockchain. Again, full DeFi deployed, will be deployed on the chain, verified, open source, everything. So there's again, don't trust, verify, code is law. You can verify yourself what's going on there. And you don't need to rely on any outside calculations or anything to be correct. And that's the beauty compared to the system we built for the other protocol back then, because it's all on chain and verifiable. And what they do is this smart contract creates one shared forge that the contract has control over. It's an asset forge, and whatever based BUSD that comes into the contract will partly be put as collateral into the forge, and then this forge is used to mint. So they create B assets. So for example, if they define to create BSBY, B Gold, and B MicroStrategy, part of the BUSD is put into forge and mint those assets, and the other part of the BUSD is used combined with those minted assets to be put into liquidity. So this contract now holds a delta neutral position in those assets, because on the one hand they are short the asset via the forge, so they have to pay, it has to pay back the asset, but on the other hand they have the liquidity position in the DEX, so they can always the smart contract can always liquidate the position and pay back the loan. But they earn commission on this liquidity while it's there. And the smart contract, while I say it's a different level than our tool back then, did the same thing but with only one asset. We called it single mint vault, and this now has the possibility to define a list of assets with a defined ratio between them, or weights. So to say, they could say 50% of the forge 50% of the assets should be used for SPY, 25% for gold, and 25% for MicroStrategy, or MicroStrategy just 10% or whatever. So they could, I guess they will define it for the assets that they have, up to 5 assets, I guess, because above that it might be too expensive regarding gas and everything to update, but can define first 5 assets that they go live with, and have the ratio how they expect needed liquidity, and then anyone in the community can provide the BUSD, and internally the smart contract does all that stuff, has the correct ratio, makes sure that this forge stays within the defined collateral ratio. For example, they could say it should stay between 190% and 210% ratio, because 150 is the minimum. So this is would be a safe bet to keep it at 200%. And whenever the system and the forge gets out of the range, the community, the smart contract updates the tokens. So either takes more loans, they put some BUSD out of the collateral, takes more loans and put it into liquidity, or if it has to, the ratio is too low, it takes liquidity out of the DEX, paybacks the loans, takes the BUSD and puts it back into the forge. to increase the collateral ratio again. Does all those calculations within the smart contract, what to take and so on. The only thing that's needed from outside is a call, because there is no automation on an EVM. So it can't do that fully automatically, but there's only this update distribution function. And if anyone can call that. If anyone calls that, the smart contract internally checks, do I have to update the distribution of the assets? If yes, react accordingly, all the calculations already in the code on chain. If not, nothing is done. So whenever someone calls that, it just ensures the safety there. And I assume that they will, so BasedAssets will run a bot or multiple bots to make sure that this is always called in time and monitored. And honestly, I expect them to be the first ones to use this provider. So I expect them to use that themselves to provide liquidity in the pools, which would be the smart choice, because they want liquidity in there. And if they use it and they put a lot of liquidity into this provider, it makes sense for them to run the bots, and therefore they anyway run the bots and provide that service to the community. And anyone from the community who puts in BUSD profits from possible commission here, but also provides liquidity to the system. So it's a win-win. Maybe one word about risks here, because nothing is completely risk-free. The thing is, as I said, it's delta neutral, but it could be, of course, that you get impermanent loss from the DEX position. So it could be that that goes completely out of whack. Impermanent loss on delta neutral positions is far less than the impermanent loss that's usually talked about when you do liquidity mining, because you have the asset, because you have both sides. But it is something to consider. If anyone is interested in that, I can do a video with some calculations on possible impermanent loss for this scenario. But it's, just needs to be considered. Also, you pay a small interest rates on those assets. I think it's the base interest rate is 1% a year, so APR. But I guess if they see that those interest rates are too much for the liquidity providers, they might reduce that because they want liquidity in there, right? So that's that. But I think if the system is used a lot and there is demand for that on the DEX and there's a lot of trading, those 1% is likely not even anything that you notice, and you get a lot of commission from here. But we will need to see. On the other hand, that's also something important. If anyone redeems a token, so withdraws BUSD, you have a small withdrawal fee on that, but the fee doesn't go to BasedAssets or anything, but the fee just stays in the system. So whenever someone withdraws funds, anyone who is still in the system profits from that, because their share increases. Also, how they do it is you deposit BUSD and you receive an LP token. So it's a bit like liquid staking. You put it in and the value of the LP token just increases, or hopefully, if everything goes well with the commissions and everything, the value of the LP token just increases in BUSD value. So you can consider it as a swap, which is good because there are no direct rewards coming in, which is for some people good for tax reasons and easier for calculating and everything. And as I said, if you withdraw, the value within the system just increases. So the ratio between LP token to BUSD increases. So all existing holders, anyone who stays long-term and provides security long-term, profits even more. And another thing is that they mention in the white paper that the funds that they get, so the fees that they get from people using the system, they get into the treasury. And they mention that those treasury funds might be used to incentivize liquidity. And that would be exactly what they can do with such a system. So anyone who uses the liquidity provider, if they take the funds from the treasury, swap them to BUSD and inject the BUSD directly into the liquidity provider, so deposit to the forge or just send it to the provider address, that also increases the value of the LP token. So this boosts the reward, so the yield that those users get. So that's an incentive that they can do easily with that sort of system. And so it's really a win-win. They make it super easy for end users to provide liquidity in a delta neutral way without having to take a position in an asset. So also people can provide liquidity and profit. If there are high commission on that, they can profit from that without creating artificial demand for those tokens, which is also a nice thing, because that's also something that lead to a lot of troubles in the other protocol. So that's the liquidity provider. So I think those are the two things that might be interesting for end users or for the average user who uses the system. Just for completeness, let's also quickly talk about who actually uses the system, and that would be the decentralized minters, traders who need to go short. So if you want to trade the asset, but not just buy and sell, but sell first without having it, so profit from falling prices, you will have to create a forge yourself mint token and then sell it. So it's possible to go short, but you have to use the system, and decentralized minters who make sure the price is in check and everything. They use the system directly, but yeah, most of the users will likely just stay on this side. But anyone can move over to this side. But if you are interested in that, watch the other video, because then you get more insights on what that actually means and how to use that. Yes, and that's basically it. That's all you need to know about using the system and what you want to use the system for. If this sounds interesting for you, if you are one who would use that, leave a comment. I'm always interested to hear about people who are also into such systems. Also, if you want to get more insights on a specific topic, if there are questions, opens, or anything, please leave a comment. Then I know what to cover in the next video. I might do some code reviews, but that's likely not for end users. So yeah, if you have any questions, anything, any open topics, any comments, leave a comment. Always looking forward to reading them. And with that, see you in the next video.